Today's Talk About It Tuesday question is, I know I should be investing, but I'm waiting for the right time so that I don't lose my money. How will I know when the time is right? I hear this question so many times because people tell me, I'm going to start investing when I get a raise at my job so I have more money. I'm going to start investing when I get this settlement. I'm going to start investing when I get my tax return. I'm going to start investing anytime they think they're going to get more money than they have now, right? And so everybody's worrying about this timing thing or having enough money. You have enough money, right? Most investments today you can get into with as little as $25, right? So if you did an index fund, sometimes it's no minimum. You can do $1. When you're talking about bonds, it's $25. When you're talking about, there's so many things you can get into now that you don't have to wait for. And why should you do it now? It's about time in, not timing. The way investments work, time is the major component in growth, right? When you're doing earned income, effort is the major component of growth. Meaning, if you work, if you give some exchange of labor, then you get money in return. With investments, you put the money in and it grows over time because it gets either interest or increase in value. But it's time that does it. And so you get compounded growth over time, meaning it doesn't grow linear the way work does. It grows exponential, but only with time in, not timing. And so that idea of I'm waiting for the right time in the market so that I don't lose, the market is in a constant state of flux. It expands, it contracts, it expands, it contracts constantly. It is not a constant in terms of how many years, but it is constant that it will do that. It will expand and then it will contract and it will expand. And here's the thing. If you are in a broad set of assets, right? So if your portfolio is what we call diverse, then every time is the right time. I'll give you an example. When the stock market starts to go down because of certain economic pressures, the stock market begins to decline. When the stock market begins to decline, correlatively, interest rates tend to go up. Interest rates going up, or vice versa. Sometimes when interest rates go up, it drives the stock market down. So those two things are not up at the same time. So what does that mean? It means you can dump plenty of money into interest-bearing investments such as CDs or money market accounts or even high interest savings accounts or Series I bonds or things like that, right? And so as interest is going up and you put money there, you're gaining money there. At the same time, it is a perfect time to invest in the stock market because if you invest in the right companies that you know have long-term value, you're now getting them at a discounted price because inevitably they will go back up. So what do? You buy the companies that have value, who have a depressed price or a discounted price right now because they will go up. Simultaneously, when interest rates go up, the price of real estate tends to go down. But real estate you can buy in any market. You can buy it when it goes up or down if you're looking at it as an investment in terms of getting rental income. As long as the rental income covers the cost of borrowing, it doesn't matter if the interest rates are high or low. Because if you bought it with the interest rates high and the price is low, yes, you pay a little more in interest. But when the economy shifts and the interest rates go back down, guess what? You can refinance at a better price. So it doesn't matter. You can get into real estate at any time. You can get in the stock market. You should be getting into the stock market primarily buying a lot when the prices are low. But of course, you got to rebalance your portfolio and you weight it a little differently when the stock prices are high. You don't want to buy a lot. You want to just reap the benefits of what you bought when it was low. And the same thing when you get into interest-bearing stuff because the stock market is low, then you take that money out and put it other places when interest rates start to decline. So the bottom line is now is the right time to invest. Tomorrow is the right time to invest. The next several years, the next decade, the next 20 years, as long as you're alive, you should be investing. And the bottom line is, you'll never find the perfect timing. You'll never have the perfect amount of money to get started. The time to start is now, because again, time in an investment is where you get the value over time, not the timing. So time in, in, over time. That's how your investments gain value, and that's how they can generate income for you, as opposed to waiting for the right time. If you're waiting for the right timing, that means you're thinking short term, right? You're thinking trading stocks, but that's not an investment. That's trading. You're thinking flipping properties, but that's not investing in real estate. That's flipping, right? And so when you're talking about investing, it's about long term and having money in there over time. The longer it's in there, the more you're going to make. So stop waiting. If you have $25, you need to start investing. And as soon as you invest in one asset class, start spreading that out, because as one goes down, another's going up, and vice versa. So you should always be making money just from different asset classes over time. So hopefully that can ease your mind. And is there a risk of losing? Of course, there's a risk of losing something. You'll lose a little here, but you'll gain more there, and it'll balance itself out in the positive if you make good decisions. But always a risk when you're investing. There's a risk in everything in life. But I'd love to hear your comments and your experiences with this. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.